There's all kinds of scary headlines out there about how poorly prepared Americans are for retirement. But today I want to share with you some good news, and more importantly, what we can all take away from this news to better prepare ourselves for retirement. Let's go for a walk and talk about it. So the good news I'm sharing today is Fidelity Investments, which is one of the largest providers of 401ks in the country, releases a report every quarter and shares a lot of data, but one of the things they share is what percent of their 401k participants have $1 million or more in their 401k account. In this latest report, year over year, the number of 401k millionaires increased by almost 50%, 43%. So they have 28 million 401k participants, and about 500,000 or 2% of those have $1 million balance in their 401ks. So that's the good news, and admittedly, it's not perfect news, right? It would be really good if that news was, 80% of people were 401k millionaires. We're not there yet. Maybe someday we will be. But what can we learn from this? And Fidelity shares some information. First, it took the average 401k participant a little over 25 years in order to build up a balance in their 401k over $1 million. So I think that's really important, right? The number one tool that all of us have to help us build our net worth, to help us build our savings is TIME, time. And the power of time is just incredible. And it does take a long time to save up $1 million. But the sooner we start, right? I'm here in a rose garden. The best time to plant a tree, the saying goes, was 20 years ago. The second best time is today. And that's the same thing. So what Fidelity is sharing is it takes a lot of time in order to do it. Now, remember, it's not just time, and it's not just the ability to save money. We also have to beat inflation over time. And compounding, the saying goes, compounding is the eighth wonder of the world. So your money starting to work harder for you in your accounts, but that only happens if we beat inflation. So sometimes that warm and cozy feeling, that risk-free, quote unquote, risk-free feeling of having our money in a bank account and having the balances not go up and down every month, that warm and cozy feeling comes at a cost. And usually that cost is the money we have in an FDIC insured bank account is likely not going to beat inflation. So it's not enough to save, but we also have to invest. Okay, so that's the first point that Fidelity shares with us, is that it takes time. And for 401k millionaires, on average, it took them 26 years. The second is, and this is from the Fidelity report, the second is the importance of saving. Fidelity reports that the full-in contributions between the employee and the employer was 17%. That's a big, big number. And I've said for a long time that, the old adage, the old rule of thumb of save 10% a year and you'll be fine for retirement, I think that worked in my grandfather's time, but I don't think it works in today's time, right? Because for my grandfather, many of his friends and colleagues had a pension, had access to a pension. Now it's only about a little over 10%, I believe the number's 12%, of private companies offer their employees a pension. So it's very, very rare to get a pension anymore. So, the three stools for retirement for my grandfather and many folks my age, our grandparents, and maybe our parents as well, the three stools for retirement savings, retirement financial security was the pension maybe that we got from a company. The second one is Social Security. And the third one is our savings. But we have to remember with Social Security, for our grandparents and for many of our parents, their Social Security was not taxed. And for many of us, up to 85% of our Social Security can be subject to taxation. Now, not for everybody, but for some of us, it will be subject to taxation. So the three legs to this stool, one went away, the pensions for most of us. The second one, Social Security, the leg of that stool is not quite as long as it used to be because we have to worry about taxation. And then the third leg is our personal savings. And so that leg needs to be the foundation for us. So again, Fidelity reports that the average person with a 401k balance over $1 million, first off, it took 26 years. Second off, they were saving a lot of money. They had to save 17%, which is a big number. That's hard to get to. I'm gonna share with you the third one, but before I get to the third data point that Fidelity shares as to how people got these balances, I want to talk about the savings rate because it is so important. Almost half of all Americans half of all Americans that make over $100,000 report that they don't save any money at all. And so it shows just making a good salary is not enough. So how do we get that discipline in order to save if we're not there? And there's really two ways to do it. One takes longer than the other. One is kind of the slow way to get there, and the other one's the quicker way to get there. The slow way to get there is every time you get a raise, every time you get a promotion at work, half of that money goes to current you, and half of that money goes to future you. And over time, you can increase your savings rate doing that, but that can take 5 to 10 years to build your savings rate up to 20%, especially if you're not saving anything now. So I think for many of us, it's worth trying the second method, which is what I call the 50-30-20 rule. And really what that means is you're trying to keep your needs, things like rent, utilities, buying gasoline for your car, which are food, from the grocery store, not going out to eat, but just groceries. You're trying to keep your needs to 50% of your take-home pay or less. And I know that's hard to do, especially with inflation now. The second thing is your wants, and trying to keep your wants at 30% or less. That's things like going out to eat. That's things like taking a nice vacation. That's things like the cardboard boxes that get delivered to our front door, for many of us far too frequently. So 50% on our wants, 50% of our after-tax take-home pay, 50% of our pay, on our needs, 30% on our wants, and that leaves 20% left over. And that hopefully can go towards our savings. So those were the first two. The first one, Fidelity says, is time. Took 26 years to build that balance. Second was disciplined savings to the extent of more than 15% between the employee and the employer. And then the third one, really we don't have control on, but that's decent market returns. The last 20, 30 years overall has been healthy for the stock market. Is it going to be healthy for the next 30 years? I don't know. But what I do know is that over time, companies continually work on doing things better, faster, and cheaper. So if you're invested in strong companies that have strong management teams and have conservative balance sheets, or you're investing in index funds that give you broad exposure to companies like that, large companies that are doing very, very well, and hopefully are going to continue to do well into the foreseeable future. I don't know. None of this is financial advice. It does take being a little bit of an optimist to be a successful investor, and I am an optimist. So I do think over time, stocks that do well, stocks that increase their cash flows and their earnings over time, hopefully will go up in value. Okay, another part of the Fidelity study that I think is really interesting is the difference in the savings rates in the 401k balances between baby boomers and the next generation behind the baby boomers, the Gen Xers. And just as a refresher, the baby boomers are just now, the youngest of the baby boomers are turning 60 years old this year. So the baby boomers now, believe it or not, are between 60 and 78 years old. And the next generation is 44 years old as I record this to 58. And the balances in the 401ks were almost identical. This is for people that had 401ks for 15 years or more. And it's just a little over $500,000 For the baby boomers, you're going to be surprised at how close it is. It's $543,200. And for the Gen Xers, it's $543,400. So there's just a $200 difference. And so starting early as we can is important. Saving as much as we can is important. Investing for the long term and beating inflation, I think, is important. And the Federal Reserve would back this up, because almost half of Americans, 48%, say that they have 0% in retirement savings. And one other point that I think is really important on 401ks, 401ks can be pretty flexible, and many of us have the ability to take out loans on our 401k, but you want to be careful, because if you change jobs, oftentimes you have to pay back that loan. So that can lock you in, or that can put you in a situation, if you cannot pay back the loan, where it might be taxed as a withdrawal and taxed as ordinary income. And if you're not 59 and a half, you could be looking at that 10% early withdrawal penalty. So be careful on loans. And Fidelity says that it's almost 20% of 401k participants, it's 17.8%, have an outstanding loan on their 401k. And I don't want you to get surprised or get a shock. So that's one of the reasons that I want you to be careful with the loans on a 401k. And I think you'll also find it helpful to see how do you compare to other Americans. And that's why I made this video here that talks about you're likely doing better than what you think on your finances. I'll see you in that video. Thanks for watching this one. Bye-bye.